The next thing that we're going to talk about is accounting regulations. So generally accepted accounting principles are the group of concept and rules that financial accounting is governed by. We call these GAAP. In the United States, they're referred to as US GAAP. Each country has their own generally accepted accounting principles, and any company who does business within that country has to follow those rules. So for this, any company that is in the United States needs to follow these generally accepted accounting principles, or US GAAP. US GAAP is created by the Financial Accounting Standards Board, which is also called FASB. It's a board within the United States that makes accounting regulations and laws. We also have international standards. So it is very rare that a corporation only operates in the United States. So for corporations that have locations in multiple countries, we have international standards called IFRS, or International Financial Reporting Standards. Most companies have to report following US GAAP and IFRS. So IFRS and US GAAP have been working to come up with a framework where they have a combined set of rules for companies that operate globally. So FASB, the US Standard Setting Board, and IASB, the International Accounting Standards Board, are working together to make it easier for international companies to follow accounting rules. There are still some rules where US GAAP and IFRS do not agree, and you'll learn about those as we come to the accounting concepts that are related to those rules. US companies should follow US GAAP rules over the IFRS rules when there is a difference between those rules. But a company that is an international company who just has locations in the United States would have to follow the IFRS rules unless they wanted to sell stock on the New York Stock Exchange. If an international company wants to be listed on the New York Stock Exchange to sell stock, they have to follow US GAAP rules for accounting and reporting. Under US GAAP, we have principles, assumptions, and constraints. We're going to talk about some of the principles, assumptions, and constraints that drive accounting. The first are these four accounting principles. So the measurement principle, or the cost principle, is also called the historic cost principle. What this principle states is that accounting information is based on the actual cost that can be proven. So accounting statements should be reliable and not subjective. So we need documentation that proves the financial information in our accounting records. What this measurement principle or cost principle states is that we should record items in our accounting records at the actual cost that we paid for them. That seems like a pretty simple rule. When it gets complicated are things like when we buy real estate or other equipment. Say you went to a car dealership and you were looking at a car that had a sticker price of $18,000. And through negotiation, you paid $15,000 for that car. Now it's possible that car, the market value is $18,000. So I might say that since that car is now an asset of my company, I want it to be recorded at its value. Well, this accounting rule says you can only record it at the price you paid for it. So it doesn't matter that it's worth $18,000. Your receipt says $15,000. So that is how it goes into your financial accounting record. That's the cost principle. The revenue recognition principle states when we can record revenue. So both of these things have to be true in order for us to record revenue. First, we have to have provided some type of good or service to our customer. And we have to have either received money or the promise of money from the customer. We'll talk more about revenue recognition in later chapters. Expense recognition is also called the matching principle. This means that our expenses are matched to revenues. So expenses are recorded with the revenue that incurred that expense. Those two principles we get further into in chapter 3. The full disclosure principle states that we're going to report any information that a user needs to make decisions about our company. We're going to provide our financial statements, and if there's something in the financial statements that we think they need to know that isn't clear in the financial statements, we're going to write a paragraph or two in the notes to the financial statements that explains what is happening behind that number. So full disclosure. One of the examples of that would be in things like where we had the land hurricane last week. So that damaged businesses. That is what is called an unusual occurrence. But businesses have to record losses in their financial records. So they might have lost inventory, they might have lost equipment, and they record those on those financial statements. Now, if I'm reading a financial statement, all I'm going to see is one line in a financial statement that says loss and an amount. I need to disclose what happened there. And so I'll write a paragraph that will say, in August 2020, there was a storm that created loss, and this was the loss that we recorded. Then we have accounting assumptions. So accounting assumptions, we have the going concern assumption. This states that the business is presumed to continue operating at all times instead of being closed or sold. What this rule means is that we record accounting information about this business with the belief that this business is going to exist forever. The monetary unit assumption is that all transactions and events can be expressed in monetary units. What monetary unit that is depends usually on the location of the company. For the purpose of this class, we will be using US dollars as our monetary unit. So everything that is expressed in this class will be expressed in US dollars. The business entity assumption means that our accounting records are separate from any other business and our owner's accounting information. This means is that we keep different bank accounts and accounting records for the business that are separate from any other business we might own, that are separate from the owner of our company. If I'm a single owner of a business, I don't just lump everything into the same records book. The time period assumption assumes that accounting information can be broken down into time periods. Months, years, and quarters are the three most common time periods that accounting information is broken down into.